Good morning, everybody. So my name is Dimitrios Goranitis. I'm leading risk and regulatory practice of Deloitte in Central and Eastern Europe. Yes. So today is the fifth day of the risk and regulatory week. Before I jump into introducing our panelists for the day, what I would like to point out is that the first 4 days of our week were mostly focused on the response to the crisis and the response to the regulatory deadlines. Yes, and what makes the fifth day of our week, I think, the most special of all is that it addresses the future. Yes, so it's not just about COVID. It's not just about regulatory deadlines. Yes, it's how risk is becoming a partner of the business. Yes. So without more delay, I would like to introduce the speakers of today, the panelists of the day. If we can move the next slide. Yes, thank you. Today we have Thomas Wenzel and Georg Vetter who are gonna speak to us about the need to digitize finance. Yes, and I think that this is a subject very close to everybody's heart these days. And then Dr. Stefan Ebenfeld is gonna take the lead and talk to us about sustainable finance. What was a luxury of the past for all of us now becomes a necessity. Yes. After Stefan, Odion Odwin is going to take the lead and speak to us about AML and financial crime. Despite COVID and despite the very turmoil that we live in our economies, AML still appears to be the main hurdle in the banking sector. Yes, and we're going to close with a subject that other moderator I'm very interested to listen to as a professional. Dr. Sven Kleinecht is going to speak to us about cloud. Yes, so it was always in our mind as something of the future. Yes, but I feel the future is now. So we're going to be very interested in seeing what Sven has to say. Just a bit of housekeeping for the day. If you participated in other sessions, you know that the audience is muted. Yes, you can communicate to us and give us your questions through the chat box. Yes, all questions are coming to me, and I will try to address as much as possible. If we don't address in this session, be sure that someone will be reaching out to you. Yes. We're also going to have, similar to the other sessions, poll questions, and the poll questions help us in understanding your focus and your interest as well. So we keep updating the agenda and the direction of our discussion. Yes. So we very much encourage you to send us a message. Yes, it's in the most powerful form. Yes. So I wouldn't like to delay any further. So I'm gonna jump directly to Thomas and Georg. Yes, and let them take the lead on this. Thank you.
Thank you, Dimitrios. Hello and good morning, everybody, from my side. Thank you for attention to listen to us when we talk about digitalization of the CFO domain, about approaches and technological enablement of the CFO domain. And let's get started with a quote which was said by Jack Welch, I think 15 years ago. He said the biggest opportunity for big companies has come far in the digitization of internal processes. And it is pretty interesting that he recognized the need for digitalization about 15 years ago, after he retires as CFO of General Electric. So he reached the need for digitalization of large corporates. And that's what we observe actually also in the banking industry. The question is, in my opinion, not why, it is either why not, because digitalization is just the only way to survive in a traditional financial services industry, because the real financial service competitors haven't even started to attack the traditional business models of the banking industry. And be aware that the tech players really agile technological, innovative, and fast movers when developing new products. So that's an advantage of the potential and future competitors in the traditional banking industry and also in the asset manager and insurance companies. But they have also a disadvantage, which is caused by the regulation, because we have a lot of compliance regulations which are spending a lot of time to get compliant and to serve the need of the authorities and the auditors. So that's an advantage of the traditional banking industry, because they are really familiar with all these regulations, and if they get digital, they are able to support three main aspects in the banking industry and also in the specific areas of business in a classic bank. First of all, the digitalization of the finance area supports the growth of a company, because if your processes in finance and risk are fully digitalized, you are able to provide your businesses and market areas with steering relevant live KPIs and to provide them in a situation where they can make decisions on live data. And also, if your processes are fully digitalized, you will enable fast and efficient product development, and it's all about being fast on the market and being innovative. So digitalization means it supports the potential growth of your business. It pays on your CEO agenda and strategy. And on the other side, digitalization and fully digital processes create sustainable low-cost bases, because the finance area has to transform for the run the bank basis into a reporting factory. The reporting factory means that everything what can be digitalized should be digitalized, so that you can spend the time with the organization on interpretation and analyzing the data you get. But run the bank is in a digital way on a much low cost basis, because you don't need as much as manual processes and manual interruptions by human capital. And the third thing is that if you digitalize your CFO domain, you will be able to be compliant with the growing regulatory requirements, because digital processes means that new regulations can be fitted in the current design processes. So maybe we can switch to the next step. We observe that there is a need for digitalization, but what we also see is that we have a lot of challenges from an outside-in perspective. What we observed during the last couple of years, that in practice projects with the goal of digitalization were often highly complex, expensive, not necessarily efficient, and were often out of time. So what we have here is some examples, and that is not finger pointing. It shows just how complex projects can be and how expensive they could be. When they fail or being so late, we identified that there are some triggers, we call it challenges, which cause maybe the failure. First of all, we identified that the costs associated with the digitalization are often underestimated, because they are not based on the real expectations from what you got from the digitalization. It is often driven by a budget. For example, let's say the top management decides we go digital with a budget of X million. And so you have to tailor and fit the program. The second thing is that skepticism is really critical, because you have to convince the people you work with and you get your team beyond when you transform your organization in the CFO domain and also in the risk area, because change is observed sometimes skeptical. The third thing is that to be digital means that your process is end-to-end digitalized, from the front office application and from making the business until the last figures in the reg reporting templates or in your annual statements. And dependencies on these processes are often underestimated. The fourth thing is that technology and competence is often overestimated, because we observe that the potential of IT systems, people internal as external, are often overestimated what systems can prove on and can do with. So being realistic means the thing is what you should do. And the fifth thing is, in my opinion, the critical one. Often IT transformation projects or digitalization projects have not a clear strategy with identifiable vision and clear objectives. And that's a problem, because sometimes the team is not sure for what they do this. It has to be clear that you got an advantage with your digitalization strategy, and you should prove it with a clear business case to have the cost and benefit side and the cost side, and the benefit side should not be a monetary, it should be a holistic way. So, and that's the point. We can jump to the next slide. What we propose is to derive a clear digitalization roadmap when you try to digitalize your CFO and CRO domain. It is a phasing model which starts with classical phases like scoping, preparation, evaluation, set the target, and derive from this the roadmap. Through the different phases, you have to consider 4 key relevant dimensions. Be aware of your organization. You have to integrate the units which are relevant for achieving the CFO goal. And the CFO goal should be derived by the CEO or by the entire business strategy, and lay down the foundation that you can transform it in an agile way. Convince your staff about the need and advantage and the opportunities of digitization, and also understand concerns and take away the fear, because you need your team in the back of you, and otherwise it's impossible to do the transformation. And also, what is really relevant is to develop a finance IT target architecture. And this should also pace on the CFO vision, which is always derived from the CEO vision and strategy. And then should design the processes completely end-to-end without any exemptions, digitalize all what can be digitalized, and make it scalable, which means that it should not be relevant how many products you have or what different kind of products you have. Make it scalable. And when you consider the dimension, let you lead by some key questions. These are just examples. And when you answer these, you get a feeling about how is your status quo, and then you see it in a spot where on which kind of part or on which kind of dimension you should work on, and which topics have you already done, because I think a lot of digitalization things are actually ongoing, but you got a holistic view about the thing, where you are and where you want to go. And let's go to the next slide. What you get is you get some fields of activities which are derived by the dimensions, and some fields of proposals on which kind of dimension you should work on for the organization side, for the IT architecture, for people and processes. Because digitalization means not to be implement always the latest and fanciest technologies. It starts with industrializing your processes, makes them scalable, and then you are able to digitalize parts of your architecture and parts of your processes, and then you can get rid of manual interruptions and high involvement of human capital in doing some nitty-gritty Excel spreadsheet work, which is already known in most of the banks which I know. But that is a clear roadmap and a clear approach on which kind of fields you should work on, and then you go further after this. You develop a roadmap with clear time framework, and then you derive from this some projects or some sub-projects, and then you make them achievable, how you can achieve the goal of digitalization in the finance and CRO area. And I think that is really an approach which should work, which should be followed, because just to focus on the IT side has caused some problems in the past, and I think it's really relevant to put a holistic view on it. And that's from my side. I will jump on the next to hand over to Thomas Wenzel, because he will show us an illustrative example of one spot in digitalization in the field of accounting. Thomas,
thank you.
Thank you.
Thank you. Digitalization, that it is important. We heard a lot about it. Now the question is, especially in finance, I mean, the client interface is pretty clear what means to be more digital. What does it mean in finance? And I chose an example that is at the core of finance. It's the so-called record to report process. And now, before looking at the solution, let's have a look at where's the problem today. The problem is, to put it in a nutshell, it still takes a lot of time and a lot of manual effort, a lot of Microsoft Excel use. And why is that? If you look at the entity close, I think there are some specific areas of attention. We have the account reconciliation, or I prefer to say substantiation of accounts. You look at your GL accounts and you need to be sure that what's in there is correct. Sounds easy, but with a huge number of different systems for operations, etc., you need to bring these things together, which is a challenge. Bringing together items refers then also to transaction matching. That is an expression that means all the activities you need to do to match the data before you can actually reconcile your GL accounts. And if you then find that you need to do some bookings as a result of that, these are the journal entries that are initiated by account reconciliation. And on top of that, you have the complication of intercompany transactions, which then leads in the group close to some challenges in intercompany reconciliation. Where do we see challenges in this, and why is it complicated? Why does it take longer? Let's have a look at the next slide, where we did focus on the account reconciliation. I just want to select some examples. The obvious is the technology is not perfect in financial services, especially. It's numerous different operational systems and sometimes also disparate ERP systems. And to reconcile GL accounts, you need to look at data from other systems. How do you bring that together? And how do you easily collect to review it? And how can you document it in a way that you don't need to collect it again if internal audit comes and wants to see it? Sometimes there are homegrown tools to support it, but with the typical problems of homegrown tools, that's technology. Apart from technology, there's also I would say, governance aspect. We've seen that it's possible to rationalize reconciliation frequency depending on risk factors, depending on materiality. But for that, you need a structure and a system to do that, because otherwise you have to look at all accounts every month. and that causes part of this manual work I was referring to. Also, aspect of, say, the organizational model, delivery models called here, to that you have disparate templates, formats, various teams and people doing a lot of jobs, and then they are doing a bit of reconciliation. So that's also causing challenges. And finally, the dimension of data and analytics. You have no single dashboard to see where are problems, where are bottlenecks, and where are, for instance, out of balance items that are there for a longer time. You can do a checking list in Excel and everything, and then it's done like that. But we believe there are better ways than that to solve this issue, because in account reconciliation, this is a sort of a summary of the challenges that cause this manual work, and also the time it takes to perform the entity close. Now, I would like to add another focus, which is intercompany on the next slide. Intercompany transactions is slightly different, but the challenges you can look at in the same dimensions. I mean, on the left-hand side, it's just a symbolic picture I liked very much. Therefore, I took it here to show the challenges. Basically, intercompany means, as the word says, you have transactions between different companies in your group, which often means different systems, different procedures, no centralized system except for the group close, but that is honestly too late to sort out the root causes. That's why I put in the header, automating processes for intercompany reconciliation. Sounds nice, but does not solve the root causes. You need to automate one step before. That is where the problem arises, to make sure that the manual intercompany process, the whole chain, is supported, and not only at the end. Also, in terms of governance, often there is a one-to-one agreement. Then you have the business segments or business divisions that work in silos. You have delays in the whole process, and sometimes topside elimination and entries that are not really verified. And also here, if everything is individual and mostly manual, it's difficult to get an overview. In addition, you have sometimes no globally standardized chart of accounts, which is also a challenge. And that is, by the way, something both in reconciliation and in intercompany that, I mean, I've done 27 years in financial services advisory, and I learned banks are very special. But in that aspect, in some way, it's common to other companies, and maybe it's helpful to look at what's happening there and what's happening within banks already as well. And therefore, I want to show a very shortly, within that time frame, what is one solution that can support you in order to solve the problems and challenges here, which I put together on the next slide in one summary chart. Slightly complex, but maybe I can explain the main parts of it. I'm going to show you the basic functionalities of software that's in the market 20 years and started off with the Sarbanes-Oxley requirements in the US, which is Blackline, which is since 2018 now a solution extension of SAP. And what you have there is, at the one hand, you can see it in the middle on the left-hand side, the modules like intelligence rules for automated transaction matching. You have the opportunity to do the account reconciliation and document what you have done, comment what you have done, and you have the possibility for automating journal entries. But most important, from our view, as being Deloitte, to look at what should be in a correct way, is a layer below, that is the audit trail to the whole thing. You have preparers, approvers, you have access of managers in various functions, and also internal and external auditors. So the whole sending around documents and having it stored in different locations, in addition to the automation function that you find in other tools as well, here you have a very nice audit trail and a special focus. I would also comment shortly on the intercompany hub. SAP, which works very seamlessly with Blackline, has also an intercompany reconciliation module. Now you will ask, if that's part of SAP, why do we need an intercompany hub? Precisely to address the problem I mentioned before, to sort out the problem before it comes up in the group clause. So to have a hub that everyone that's working with intercompany works with the same data, and this also creates invoices that are then automatically say matchable on the both sides of the transaction. And my favorite comment to that is it's a good solution, and yes, we have hundreds of people that can configure it, but it's not plug and play. As we have seen in the comments that Georg made before, and also the aspects I mentioned before, it's important to match good digitalization solutions with smart processes that are adapted to these solutions to address the governance and organizational and structural issues that we have mentioned before. But if you do that, you can achieve a higher quality of your accounting, and at the same time to save costs. That should be it in a nutshell, to show you what does it really mean beyond a nice screen for your customers, really in internal organization, especially in finance. How can you be more digital, and how does it work? Yes, more than happy to comment any questions. And also, I believe we have prepared some polling questions, that is us asking questions to the audience about certain aspects about what we've just presented.
So the question in this case, Thomas, is how digital is your finance division already? Yes, and you're giving a scale from 1 to 4, 1 being the least and 5 being the most. Yes. So while the audience is taking some time to respond, I would like to bring the audience in the discussion as well. And we receive a lot of questions. It's a very exciting subject, and if COVID was not the buzzword of this year, it would be digital. Yeah. And I will select the one that repeats the most and seems the most practical for me. Yes, so the banks had weak profitability. Yes, COVID is only making a situation harder. What you described, Georg, already indicated that it is a big investment, not just monetary. Yes, it's the effort to do it. And the question is, you are performing this work. Yes, it's not theory. You are assisting a lot of banks in this journey. So what is your opinion regarding the result? I mean, simply said, does it worth it? Do the banks that you're supporting see the benefit?
I think it's a very valid question, because obviously it's an IT will tell you, okay, it's another system, it's another investment, can't we do without it? And I can just comment that if you do it right, then it will not only be another system, and it will not only be better quality of your accounting data, it will definitely cut down costs. With the only one exception that someone says, I don't look at my balance sheet validation and reconciliation at all, but that would, in my view, drive up the cost of compliance, and certainly for a bank, not recommendable at all if you look at the recent news. So there is a clear case for cutting down costs with these solutions.
Okay, so the business case is there, yes? I mean, obviously.
Also the economic business case, to make it very clear.
Okay, and I'm looking at the results of the question. I mean, it's very clear that most of the banks are someplace in the middle, but very much skewed towards less digitalization. Yes, which shows, I guess, how much more ground the industry has to cover.
Absolutely.
Yeah. From my side, I will add 3 aspects which should be considered always when you derive your business case for doing such huge transformation plans. The question is, what is the intention of digitalization? It is more to save costs on a short base. It ensures really your business. It means client expectations are changing really fast, and you have to develop new products, new services in really fast in cycluses, and you have the need to provide high qualitative services to your customers. And digitalization of the CFO domain supports this, and also it ensures the regulation. So the business case is not just on the cost side. It really helps you to improve the business side, and it really improves and supports to fulfill the customer needs.
Okay, I was just suggesting that we jump to the next question, which is what kind of technology you believe will influence the becoming more digital most? So RPA, I'm always a friend of explaining, even if it's widely known, it's a robotics process automation. AI is artificial intelligence, and the other 2 are clear, I believe.
And Thomas, what will be your answer to this question from an industry point of view?
I was happy to see that panelists don't vote, but honestly, I think all these topics are talked about a lot, but then the question is, what does it mean in practice? And I think if the most potential, I would say, is somewhere between data analytics and maybe AI. With RPA, you can use a robot to automate what you're doing now manually, but you stick with the same processes. Maybe there's an advanced stage to that. Let's see. Yeah, at least the audience seems to be spot on. Or they pressed the button after I commented it. I don't know, but yeah, I think you need RPA, you need machine learning, but I think the most challenging part where you can take out most is the data analytics supported by AI. Now I think we have a 3rd question, and in interesting of time, maybe we can switch to that already, because that is especially interesting regarding the last practical example I've been showing. We talked about the substantiation and reconciliation of accounts, talked about matching of transactions, the automation of journals. That depends on, is journal booking a very manual process? Do we have many bookings, or is it something that we only do twice a month? And intercompany, and would be interesting to see what is most interesting for you, or we were very open to say, okay, everything is fine for you, not a topic. Now let's see what comes out. Okay, so I'm happy about the 5%.
There is a tie.
Yeah. It was. I thought it was maybe courageous to open the last option, but it should be fair. And yeah, account reconciliation, we get a lot of question about it. Interesting to see that journal creation is also a topic which is significant. And I think these are the levers together with the other two that you can really cut down your costs with an initial investment, that's for sure, but it should trade off quite quickly. Thank you very much. It was very interesting to be here.
Very interesting indeed. Thank you. Thank you both.
Thank you very much.
So, without a lot of delay, I would like to jump to Dr. Stefan Ebenfeld. Stefan, if there was a second buzzword in the year, yes, if it wasn't COVID, it wasn't digital, it would be sustainability, yes? But,
yes, I would think so.
But help us understand, help us framework the subject of sustainability for the banking sector.
Oh yes, actually, what I'm presenting today is very much of an overview talk, and I try to touch about well, a lot of topics and give relations between them. So I would like to start with an overview of actually the regulatory initiatives first and the respective field of actions that derive from those initiatives, then say something about how to implement such a plan, and then have some deep dives into what I would consider the most relevant areas when it comes to at least quantitative measurement, and that would be like impact of climate and ESG risks on credit ratings on the one hand, and actually dedicated climate stress testing on the other. So it's a full agenda, and yeah, can we go to the next slide, please? Good, thank you. So, okay, so this is a practitioner's perspective, and actually, so let's start with what I think is driving, at least from the regulatory side, well, the development in the industry. First of all, the TCFD recommendations, I would say in 2017 kicked it all off. They were essential. So I mean, obviously there have been initiatives before, but since the TCFD recommendations, I would think climate risk and later ESG risks are much more recognized than before. And that was, I think, for two reasons. The first is actually that these TCFD recommendations brought with them a sort of change of paradigm. Before 2017, the industry looked at sustainable finance mostly in terms of non-financial risk, reputational risk, and so forth. But the TCFD recommendations strongly recommend to look at climate risk in terms of financial risk, which is really different. Secondly, the paper was very well structured, and actually the structure along the categories governance, strategy, risk management, and disclosure comprising metrics and targets, is actually something that is reflected in essentially all the requirements that we see, I would say, across the world, in particular across Europe. Well, based on the TCFD recommendations, the United Nations had a pilot project with 16 large banks and developed a methodology framework for quantitative assessment of climate risks. And they brought forward two interesting papers. The one was about transitional risk, and I think this is the most influential one, because actually the UNEP-FI methodology is, if you wish, the industry standard at the moment, if there is such a thing. You can argue if there's such a thing. And then actually there was also a second paper about physical risk, focusing on mortgage, energy, and agriculture. And at the moment, I would think the industry is mostly discussing how to integrate both aspects, and actually more about how to integrate physical risk in the transitional risk approach. The next milestone from my perspective is the EBA guide on loan origination and monitoring, not because it's so much about ESG risks, but it has a rather small chapter in it about ESG risks, but it sets like the agenda for credit ratings. And this is, and loan origination. And this is on the one hand, okay, you need to incorporate ESG in your risk appetite policies and procedures. This is, if you wish, a straightforward generalization of what's in the TCFD recommendations already, just extending the scope from climate to ESG. So environmental, social, and governance, the whole scope of sustainability. But very important from a quantitative perspective is the second aspect, and that's the requirement that you should incorporate ESG and in particular climate risks in your credit ratings. Then the next hallmark of, sorry, let's back to that slide. Sorry, I'm still on the left-hand side. Thank you. The next hallmark is actually the ECB guide on climate-related and environmental risks. This is, well, because it contains inter alia two very important statements. The one is that at least the ECB has made up their mind that you should integrate sustainability, that is climate and ESG risks, in your existing risk categories, as opposed to defining new risk categories, be it climate risk or ESG risk. Secondly, it refers to the ECB ICAP guide, where there is an opening clause, and that says if risks over a longer time horizon, as you would typically consider in your ICAP, are material, then you should consider this longer time horizon. And this is really important for climate risk. Last but not least, the current EBA discussion paper on the management and supervision of ESG risks in the financial industry is noticeable mostly because it categorizes quantitative approaches into essentially three categories. Firstly, there is the portfolio alignment method that asks how much is your portfolio aligned with sustainability targets, and quantitative approaches like climate heat maps or the so-called PACTA methodology, which is an open source approach to climate risk measurement, would fall under this category. Secondly, and probably the biggest category, is that of the risk framework method, which comprises inter alia climate stress testing and scenario analysis. And finally, the exposure method, which asks for the impact of ESG and climate risks on your individual clients and exposures, and actually ESG scoring would fall under this category. Having said this, what could be the fields of action as derived from those initiatives? To keep it very simple, you could find essentially three such fields of actions. The first would be risk identification and risk inventory, and the most prominent considerations would concern the ESG taxonomy on the one hand, and the measurement methodology on the other. And as I mentioned a second ago, actually, for the purpose of risk identification, you would think about like climate risk heat maps and PACTA when it comes to climate risk, or to ESG scoring when it comes to the broader scope of sustainability. Then the second important field of application would be loan origination and credit ratings. Well, for loan origination, you can like take the point of view and say, well, essentially the methodologies you can apply are the same as for risk identification and risk inventory. But then actually you have to ask what to do with your credit ratings, and essentially there are two main approaches. The one is when you look at ESG, you may have an ESG score and consider such an ESG score in your internal credit ratings by means of override or notching. Then secondly, there is a more economic modeling approach, and that is the UNEP FI methodology, upon which I will have a deep dive later. Now, the third field of action is around stress testing, and you can and you might want to distinguish the stress testing in the context of, say, ICAP, and the climate stress testing with a rather 30-year time horizon. So, and if you want to understand what's the spectrum of what's out there, you can look at the regulatory climate stress tests that have been performed in the past or are announced for the future. And to have two, well, blueprints or benchmarks for this, you might want to look at the Dutch National Bank climate stress test as performed in 2018, which was a mere scenario analysis where vulnerability factors were given and you had to group your exposures and multiply with just some vulnerability factors. And then, so this would be the one end of the spectrum, and the other end of the spectrum would be like a fully integrated 30-year climate stress test, such as the PRA has announced for 2021. So I was saying the UNEP FI methodology for credit risk is very much at the center of these considerations, and actually it comes with a couple of drawbacks upon which I would like to make more comments later. Good. So please, then let's go to the next slide. So I will just touch very lightly upon implementation approach of those regulatory expectations. Just to give you two takeaways from this slide. I think, I mean, we have already, or we are in the middle of performing a number of ESG implementation projects at the moment. And from my perspective, there are two takeaways. Concerning the approach, I think you cannot do much wrong if for the roadmap for your project approach, you follow the structure of the TCFD recommendations and work along, well, firstly, governance. That means you have to establish responsibilities for ESG and climate risk topics at the very top. Then you have to implement a respective strategy or amend existing strategies. From there on, you have to move to your risk management processes. And finally, we have to talk about reporting. Here it's just disclosure, but you can think about it in terms of management reports, and that would include quantitative metrics and respective targets or thresholds. The second thing is when you define your roadmap of an implementation approach along these TCFD recommendations, then the second takeaway should be, okay, it makes very much sense to align your work streams with the bank's organizational charts and processes. And actually, well, having a glance at the clock, I will not dive into the details, but you will get the material later. And I just want to point out that, well, on the left-hand side and the right-hand side, this is sort of a checklist or well, outside in first approach to implementation. Good. From there on, let's move to the next slide, please. So credit ratings. This is another very important field of action, I would think. And as I said, it comes in two flavors. When we think about ESG, so sustainability as a whole, the first thing that comes to your mind is ESG scoring. This is on the left-hand side. And actually, we have performed a benchmarking analysis of external ESG scoring providers. And I think we got away with essentially 3 lessons learned. So on the one hand, so firstly, ESG scores are typically determined by aggregating partial scores, so an E, an S, and a G score, which in turn is derived from a large number of detailed variables, detailed questions to your client. Secondly, what is the outcome that you might expect? Essentially, the subscores are, and the scores are defined by rank ordering your mostly homogeneous portfolio or your mostly homogeneous clients or exposures according to certain ESG criteria. The important point here is that none of those rating providers can actually make a direct link to default probabilities connected with ESG. So it is more a, well, you define what the ESG criteria are. They can more lean to, well, how green is your client or exposure, or they can lean to how much exposed is your client or exposure to climate or ESG risks. And then thirdly, the essentially all of these rating providers assess ESG topics on the basis of two dimensions, and this is your risk exposition and the quality of your ESG management. So, I mean, obviously, the picture here, the MSCI scorecard on the right-hand side of the left block is only an icon, but actually it's publicly available from the MSCI website, and in a sense the MSCI scorecard is the prototype for such approaches, as it starts with like defining identifiers for exposure and risk management quality per ESG, then defines subscores for ESGs, aggregates them into a whole score, then further adjusts it to make it comparable between different portfolios, and then finally maps the result to a typical rating scale ranging from AAA to C. So, so if you're interested in the details and want to learn something about the MSCI scorecards, I mean, you can obviously ask Deloitte, and if you want to do research for your for yourself in the first place, I would strongly recommend to look into the MSCI methodology, which is open source. Okay, good. Second thing, the UNEP FI methodology for transitional climate risks, which is, from my perspective, the most important methodology cornerstone when it comes to climate risk at the moment. So what is it about? Firstly, it starts with a climate scenario. A climate scenario in this context means the output of a scientific climate model, such as an integrated assessment model, like the IPCC, Intergovernmental Panel for Climate Change, climate scenario data that they provide publicly. Then you define a top-down module, and this is a fundamental analysis of a borrower level income, a balance sheet and income statement. In other words, you consider the impact of this change of those scenario variables, for example, carbon price, and first in a first step determine what's the impact on the balance sheet and the income statement. And then the assumption is that you have a rating system, be it PD or LGD based rating system, that takes balance sheet and income statements as input, and then you just insert your stressed input into your rating system and come up with a stressed PD. So this is in a nutshell the fundamental analysis. However, you can think it's very tiresome to do that for each and every borrower, because the modeling at borrower level might be different from one firm to the other. Now, if you have results at borrower level, you have to expand these results to, no, sorry, please stay on that slide. You have to expand, extrapolate your results to portfolio level, and this is typically done by clustering. So in the first place, you cluster your portfolio according to certain criteria, and then pick a representative sample of each cluster, and then perform the fundamental analysis on them. Good. So what is an industry standard implementation in this sense? An industry standard implementation starts with say, IPCC data as is, then would define the carbon price as the essential risk driver. That means the fundamental analysis would be restricted essentially to carbon price. And then the impact on the carbon price would be assessed in view of the balance sheet as of today. I mean, in principle, the methodology says you have to project your balance sheet and income statement over a time horizon of 30 years, which is not totally realistic, or you don't know how to do it. And therefore, well, the current approach is just to keep your balance sheet static. And then again, you take your internal rating system and insert the stressed balance sheet and income statement input into that. Good. So having said this, this is the, now we can go to the last slide, please. Okay, thank you. So there is a number, from my perspective, there is a number of shortcomings in this approach. And actually, I think we can show that in some respects, we have to offer some significant improvements. And the first significant improvement would contain the expansion of IPCC climate scenarios to a regulatory scope. So if you compare the output of scientific climate models, so what you can get, and what is the scope of, say, a regulatory climate stress test, you will see that the set of variables is very much larger. And actually, we have a methodology that is mostly statistically based, how to expand the information that you have to the larger set of variables, using all the information that you have by means of regression, but also auto-regression and some expert judgment. Secondly, let's come back to the principal idea of the UNEP FI methodology, that you have to project well, your balance sheet and income statement over a time horizon of 30 years. However, the question reads, given a scenario, what's the impact on the PD at, say, portfolio level? And this is actually something which the industry has, to which, well, this problem is already solved in the financial industry, and the financial industry has converged to a certain type of model. And that would be rather a firm value model, for example, a Basicek model as the most basic one. So what I'm saying is you can calibrate your climate scenario portfolio PDs using a lifetime ECL approach, as you know it from IFRS 9 in the first place, and then recalibrate your UNEP FI methodology to this much more stably calculated portfolio PDs. And then finally, there is the last question. Okay, so the current methodology leaves completely aside the assessment or the impact of climate risk on fair value assets. And this is, and what I'm saying here, or what the takeaway should be, is you can use the same methodology in principle that you can use for enhancement of IPCC climate scenarios in order to project your market data in the first place. And if you want to project the full set of market data, you obviously have to use some machine learning or big data analysis methods, such as dimensionality reduction or well clustering and so forth, yeah, parametric representation of surfaces and curves and so forth. Good. So that was a very brief overview of a well, large variety of topics. I hope you found something of it interesting for you. And yeah, well, I think we have a minute or two for discussion.
Yes, yes, Stefan, apparently the audience is very interested. Yes, so we have a variety of questions. I will try in terms of time economics to give you a couple. Yes, so
okay, good.
some of the questions are coming on stress testing. Yes, on how necessary and how optional it is. And what I think the question is that Bank of England is stress testing next year the banks on climate risk. Yes, so do you see the European regulators moving to a similar direction? Is the focus of climate stress testing gaining profile? And how advanced or not do you think that the banks are in that respect?
Okay, thank you. Very good questions. Firstly, I think it's three questions. The first is the the strict relevance at the moment. So when you think of, so okay, what do you really have to do if you don't want to? So what's the minimum agenda? The EU action plan has made it clear that actually one of the the EBA action plan, not the EU action plan, the EBA action plan has made it clear that the main entry point for regulatory requirements is Pillar 2. So and actually makes a strong connection with the ICAP. And now recall what I've said about the ECB guide on climate-related risks. Actually, there is the opening clause. So first of all, you have to assess the materiality of each and every risk already as of today. So and secondly, I was stressing the point that there is an opening clause that says if the time horizon for your material risk is longer than the typical 3 or maximum 5 years, then you have to consider the longer time horizon. So from that perspective, considering climate and ESG risks in your risk assessment process, in your risk inventory process, is already mandatory today. At least get an assessment of the materiality. Then secondly, what is the European, the EBA doing? Well, both the EBA and the PRA are working together with the Network for Greening the Financial System, the NGFS. And actually it's well known and it's already announced that they will have the very same type of advanced stress test, at least for the banks which fall under the ECB supervision. That will come soon. I don't know if it comes in 2021, given the COVID background, but actually it was planned for 2021. So that will come very soon. And finally, if thinking, well, in your ICAP, if your conclusion is that climate risks are material, the minimum requirement in your ICAP would be to consider shock scenarios and for a blueprint, look at the Dutch National Bank stress test performed in 2018.
Thank you, Stefan. Very, very interesting. Very interesting. So we all anticipate a more demanding supervisory element in that respect. Yes.
Definitely. Actually, it's already announced that once the COVID crisis is over, this will be top of the agenda. The ECB has announced that already publicly.
Okay, great. Thanks a lot. Thanks a lot for finding the time to speak about this. Extremely interesting. So again, we don't have a lot of time. I will jump to Odion. Odion, you're supporting a number of banking institutions across Europe, yes, when it comes to financial crime. And I personally come from a financial risk background, yes, but what I've seen in the last years, we outline all the threats to the banking sector, and sometimes it's capital, sometimes liquidity, sometimes it's NPL. But in the last 5 years, every few months, we have a financial crime scandal that comes to rock the foundations of this industry, yes, and sometimes the viability of the business model as we know it, yes. So help us understand the world of the financial crime.
Thank you, Dimitrios. I'm very happy to be here with you, and I'll try to make it clear with 4 or 5 slides. So our topic now is what we call the compliance function. When you work in a compliance team and when we deal with compliance officer, mainly we have 2 subjects. First one is consumer protection. We can call this as well conduct risk, and it's really a topic during this crisis, but it's not the subject today. And the second one is, of course, financial crime. Keep in mind that this topic as well is very interesting for insurance sector. At Deloitte, we are organized to address bank and insurance sector, and issues are very, very similar. So on this side, you can see that financial crime, I mean, anti-money laundering is part of financial crime. when we speak about financial crime, there are many things, many topics. The most well-known, I would say, of course, is anti-money laundering and terrorist financing, which unfortunately is now a really big priority for many countries, as you know, what is happening everywhere. The second one I would say is fraud. Fraud, it's a bit specific because it's in many countries, it's not linked with a specific regulation, like for example with anti-money laundering. But everyone knows that very soon we'll have a regulation on fraud. So banks, insurance companies, they will have to explain how they deal with fraud, the same way they explain how they deal with tentative of money laundering. And this is very interesting in the business development perspective. Then you have anti-bribery and corruption. And this is as well is interesting. Before we did not have really what I say regulation. We now have regulation in many countries. In the UK, for example, with the UK Bribery Act, more recently in France with what we call Sapin 2. And so this new regulation is as well a new topic for the compliance officer. Of course, it was already a subject in the civil society, but what we have to keep in mind is that is really in the agenda of the compliance officer. Then you have what we call market abuse and conflict of interest. This is really an important point, which is as well developing. Then I will say we have the tax evasion. You have, as Dimitrios say, we have many information due to a better transparency about tax evasion. You all remember, I'm sure, the Panama Papers. I will not say that we discovered things, but this made things more clear today, how people and some companies are working. So tax evasion is a really huge and big subject. And last, in the financial crime perimeter, you have what we call the international sanction. The most well-known is OFAC from the US, and it is where we have seen the biggest fines and sanction. For example, you might remember BNP Paribas, French bank, 10 billion fine. So it's huge, and it's really an issue because it's cross-border, and of course we have to comply with all this regulation. Regarding our focus today on money laundering, anti-money laundering, I will say that of course a lot of money is laundered every year, and of course now we are facing, as Dimitrios said, more sanctions and fines, but it's not always been the case. So if we go to the next slide, we'll see that we have had many tentatives to try to tackle the money laundering issue with regulations. Of course, it didn't start with the first AML directive. As you see on the slide, we had already a regulation links to drugs, for example, but among the EU, it started with the first anti-money laundering directive. And then we are waiting for the 7th anti-money laundering directive. In this slide, it's interesting to see that at the beginning, we started very small ambitions, first rules to tackle, I would say, offenses linked with drug trafficking. Then we extended the obligation to non-financial activities, because at the beginning it was very focused on banks and insurance, but of course a lot of activities can identify money laundering and report it to the authority. And then the key one is the third anti-money laundering directive. This one was very important because all this came from the Financial Action Task Force, FATF, and the recommendations were updated, and we had to take into account this update in the European regulation. So this is why it's important. And the second point is the introduction of risk-based approach. And this is a clear key issue, and it's always today the case in non-financial risk. And the first point is to show the supervisor, where are your risks, and then only when you have proved this, you can try to prove that you are very good at supervise controlling this risk. But the first exercise is to identify clearly where are the risks. And to the risk-based approach, this enables us to adapt the device, adapt the anti-money laundering scheme to the level of risk. I mean, well, it sounds obvious, but it was not always the case. If you have a client with high risk, of course, you have to do more due diligence, more control. And if you have clients with lower risk, you can do less. And this is very important, and it gives a bank or an insurance company a real opportunity to alleviate the scheme in order to really adapt control supervision to the level of risk. So when you are very good at demonstrating the supervisor that you know where your risks are, you can alleviate your device. So, but to do that, you need a lot of practice. And then we had the fourth directive, with I would say the key event was maybe the ultimate beneficial owner, because as you know, the key difficulty in anti-money laundering is to identify the clients, what we call the know your customer, KYC. Of course, when you are facing a natural person, it's not that difficult, but except he's using his fake, false ID documentation. But the difficulty is mainly on the legal person, because legal person, to identify the legal person, it's not only the name of the company, of course, and you understand it, but it's as well the shareholders, what we call the beneficial owners, when the shareholder owns more than 25% of the stake. So this is a very issue, because as you know, in some countries, it's still possible to hide the beneficial owner. So this was a real step ahead with the beneficial owner, and the tentative of different countries, including in Europe, to have a mandatory register of beneficial owner. And this is a real step forward for the fight against anti-money laundering, because as we say, when you know where the money is coming from, and when you know your client, well, I mean, when you really know him, including ultimate beneficial owner, the risks are quite low. Of course, there is no risk, but it's the risk is very low. Then we had very recently the fifth directive, mainly focused on, I would say, cryptocurrency, because it's a new way of moving money. So it's very interesting for money launderers. Prepaid cards, this is linked with financing of terrorism. As you may know, that some people, they bought prepaid cards. You don't have to decline your identity to do that, and they use the money to buy stuff, to make bombs or things like this. And now we are facing
I think we have a connection issue with Odwin, and while we're trying to recover the connection and connect with him again, let's jump to the first question he has prepared for the day. Yes. Okay. So the first question that Odin wanted to address to the audience is: should the control and supervision of compliance with AML regulations be trusted to a European authority? Yes, it's.
Can you hear me, Dimitrios?
So we have you back. Yes.
Sorry,
hi.
Didn't know what happened.
We lost you there. It's,
okay,
we speak about digitalization today. Yes, we should have had an interruption expected. So I introduced your first question. Yes, so feel free.
Thank you very much. And let me know if it happens again. Okay, I will check the connection. So I will say that we are the sixth directive, and now we are facing the seventh directive. Seventh directive is the quick poll question is linked with that. Because as you said, Dimitrios, at the beginning, we are facing a lot of scandals in some countries, and for some people it was due to not efficient supervision, anti-money laundering supervision in some countries. So this is why they asked for maybe the ID of EU body dedicated to anti-money laundering. So I can see the result of the poll, and you think that this is a good idea. So you can go to the next slide. You think it's a good idea to have a European authorities. So on the next slide, you can see that what is in the project. So this is the question slide. So thank you very much. So if you are interested in what is going to happen, you just have to read what happened in last November. I mean, say the 4th of November with the finance minister from European Union, sorry, they decided to, they agreed, I would say, to establish an EU body to fight money laundering. So the point is to have, of course, to control, to check the effective implementation, because this is a difficulty we have. Of course, there is a directive, but after it depends of every country to implement the directive. In some countries are very late in implementing directives, and some implement the directive but only part of the directive. So this is really a subject. This EU body is, well, it should happen, but we don't really know how it will operate. Me, for example, I think that it's still important to have a local national body really invested on this subject. It doesn't mean that we don't have to collaborate better, of course, and it's good to have a EU supervision, but it's a very complex, difficult subject. Sorry. So this EU body will control the effective implementation of the directive, will, of course, make sure that we have a single rule book. This will help all the organization, will participate to the supervision. This is still to understand how they will do that, alone or in close relationship with the local supervisor. They will coordinate better the exchanges, the communication between what we call the FIU, it's Financial Intelligence Unit. For example, in France, its name is TRACFIN. You have one of these in every country, and this is very important role in fighting anti-money laundering because, as you know, it's immediately international or cross-border issue. Anti-money laundering, 100% local, is very rare. So this is why it's very important to collaborate, to share information very fast. Of course, this European body might increase the sanctions. This will be important, and it will give a better image of Europe. As you said, Dimitrios, it's very difficult to have scandals in a. I would not say, of course, that one country is not good as another one, but because everyone has had its own scandals in Europe, but it will give a better image to see that all this is under control and we are really fighting against money laundering. So on the next slide, what I will say today is we are facing a lot of challenges, and it's really a very interesting topic, financial crime. For those of you that are working in this topic, would like to work within financial crime, so it's a very, I mean, compliance function. They are hiring a lot of people, even if the operational model is changing a little. First, as you can see on this slide, we could say that there is three steps. First one was to protect and to protect the organization and to comply with the regulation. Second one was to be a more proactive actor, because very often you have the supervisor and then there is a fine, and then the bank of the insurance company update the global anti-money laundering framework. Well, I mean, they wait for the regulator to find them. So now we are facing more proactive, and this is very important. And the third one is to adopt really to use better the technology. Because as you have seen during, I would say, the 4 or 5 years, a lot of, if you count the staff of every compliance function, of financial crime function, the staff is increasing a lot, and this is not why we don't have no longer scandal. So it means that you are more people, but you are not really better as before, or you are still at risk regarding your reputation and your image. So this means that hiring more people is not always the solution. You need to rely on the technology and to be more efficient. So this is really important. So of course, if we are speaking about the challenge we are facing today, I would say that regulatory pressure, of course, is one. You have seen this directive number 7. Maybe one day we'll have directive number 20. So it will never end. So just keep this in mind, because you know that anti-money laundering is sort of a technique to launder dirty money. Dirty money is still there. Dirty money will never disappear. I would say it's even the opposite. We have criminal activities that are developing very fast. We have new criminal activities: illegal immigration, trafficking of protected species, tax evasion, counterfeit. So when you have criminal activities, you have a revenue. This revenue is dirty money, so dirty money is candidate to money laundering, and this will never end, never stop, except if one day, and you know it's not possible, we eradicate completely criminal activities. So this is why every year anti-money laundering is in the agenda of every CEO, and now they have understood it better, because it has as well a huge reputation and damage risk. So I would say first is, of course, regulatory pressure, more control, maybe, as I said before, the EU body to supervise even closer all the banks and insurance companies. Third, I would say, I will not speak about all of them, but I will do a focus on pressure from civil society. As you said before with the sustainable presentation, this is really a civil society subject. This is me. I don't really like when we say regulation for regulation. This is regulations, but this regulation has a means and an objective. We ask financial actors to participate to fight the criminal activities. And this is very close, because it's a direct link between banks or insurance company to the civil society. And we have to be, our clients have to be good at this, even more today, as they communicate a lot in their sustainable development reports. So this is part of it. Okay, so you have a mission. The society gave you a mission. Of course, it's a bit complicated to do perfectly, but society gave us a mission. We have to perform in this mission. Then, of course, digital disruption is a topic in anti-money laundering, because, as I said before, the key point is to know your customer. Donc, when you have 100% digital onboarding, it's a topic. How you deal with that? Have you checked the identity documents? So this is a really important point. Then, of course, cost pressure. I mean, compliance function is not protected from cost pressure. It's true that during last 3-4 years, we had an opportunity to spend more money, and as we didn't have a big budget, this was not the priority for the top management to reduce the cost of the compliance function, because it was quite low. But today, clearly, we spend more money in compliance, so we always as well have cost pressure. And then, of course, COVID, which is not the key topic, but of course this in certain cases it has emphasis the risk for money laundering, because when you work remotely, of course there is more opportunity for cyber attack. For example, when you can't speak directly with your client, you have to open very fast, and it's very challenging for the bank or insurance company. Some products to be the possibility to subscribe 100% online. If you are not prepared, if you don't put enough control, this is as well an opportunity to fraudster. So this is really a subject. So you can send the last poll question if you want. So I will say that there are many challenges. So there is you can send go to the next slide and send if you want the poll question. It's about the organization of money laundering. It's a question that deals with the organization among banks, because, as I say, financial crimes deals with many things, and very often you have a anti-money laundering department, for example. I would say an anti-bribery department, an anti-fraud department, cyber criminality department. So some people are pushing that all of these are gathering, and it might make sense because in many cases they use the same tool, software with scenario rules that enable the detection of suspect clients or suspect transaction operation. So this is really a subject, mainly as well in the insurance sector, because as you know, in non-life, money laundering is very, very closely linked with, we'll say, fraud. So if we go to the last slide of the presentation, interesting to see that you think it's a good idea to gather all the people dedicated to fight financial crime. Yes, it makes sense. Well, it has to be done in a very clever way because sub-subjects are more close to the business than other one. So in some cases, it's good as well to have people working for the compliance among the business lines because it's really at this price that you can be very efficient. And the last slide I will end with this is why financial crime is as well an interesting topic because, as you know, compliance is really a good place for a lot of use cases on the new technology. Like we said before, robotic process automation, blockchain, machine learning. This is really an issue to evolve the anti-money laundering global framework. And you can see on the slide that all along the relation with the clients. I mean, on the onboarding phase, on the monitoring phase, and in some cases in special analysis, you have opportunity to use new technology. For example, I would say here digital onboarding with alert rescoring. You can deal as well on monitoring with the alert. You know, you have scenario, they generate alerts. You have to deal with the alerts. We call that as well hits. You have positive hits, false hits, and you can use and capitalize on the machine learning, to score the alert, for example, and to deal first with the more risky alerts, and to ask your team to deal with risky alerts and to spend that time in with risky alert. So a lot of opportunity, of course, you have as well robotic process automation. We rely on data quality, data regarding the KYC. Donc robotic process automation might be an opportunity to export, to go outside the company and to collect data and then to put them in the KYC folder. So this is really a key challenge. And today, when we work with our client, we always have a discussion with them on new technology. How could we implement new technology to do things faster or cheaper? And in order that, because they can't hire so many people now, they really need to rationalize their organization. So I will say, Dimitrios, that for me, I have finished my presentation. Maybe you'd like to ask some question or the...
Yes. So very, very popular subject. I think that the regulatory approach in the industry has justified the investment. Yeah. So even from a fine perspective, it's too expensive not to be compliant. Yeah. So I think that the banking institutions are really prioritizing AML. Yes. So some of the questions that came in is that from your experience, yes, because you oversee on a European level a lot of a big part of the industry. Yes. So on the use of technology, because the human hand has limitations, yes, on such an over-regulated environment. So how advanced are the banks in adapting relevant technology? So it is the solution, but where is the sector?
Well, I would say thank you for the question first. To be honest, I would say that during a certain period, because I would say the supervisor didn't really look at the efficiency of an anti-money laundering scheme. They looked at the means, the quantity of money you spent every year. So it means that, to answer your question, they spent money in technology. So this already exists. They still have a lot of investment to do. But I would say regarding the question, did they spend money on technology? Yes, they did. Is the technology really efficient? here there is a gap, a big gap. They really need to work on this technology and to use the technology to be more efficient. For example, you have a lot of banks, they have scenario to detect suspicious clients, okay, but this scenario, they are in place, but they are not efficient. They generate a lot of false hits. So I would say they have the technology, but it's not efficient. So they have to complete this to answer the question, how can I have less false hits? And then they can use, I would say, new technology. For example, machine learning that will be added to, I would say, old technology in order to have a better efficient system. Though I would not say they have nothing, they have things, but they can use it better. And to use it better, they need as well to invest again in new technology.
Thank you. And one more question. I give you 1 minute. It's a very popular question for all the speakers. Yes, and I usually avoid these questions, but I will ask you this. Very wide frame, very wide field. If a compliance officer, yes, a financial crime officer in a bank had one most significant priority for the next 6 months, what would that be?
I would say it's to ask himself if he's using efficiently all the technology he has and how he could parameterize better the rules to detect suspicious transaction or suspicious clients, and to prove the supervisor that he really relied on technology and is able within a dashboard to measure every day the efficiency of the technology he's using to fight anti-money laundering.
Many thanks for doing. Very interesting.
Thank you very much.
Again, a very interesting topic coming ahead, and I don't want to lose a lot of time. I will ask Sven to talk to us or teach us, yes, about cloud. And with my very limited knowledge, Sven, cloud, GDPR. I was watching this morning on Bloomberg about the European Digital Act, yes, and the European approach to European data, yes. So help me and our audience, but also me. Help me understand where are we.
Okay, yeah, Dimitrios, thank you very much. I would very much like to do that. My name is Sven Kleinknecht. I'm at Deloitte, Germany. I'm dealing a lot with IT compliance in the banking sector, financial services industry, and I'm doing a lot of work in cloud compliance. And I want to give you a quick overview, a quick insight on what's happening there. And as Dimitrios said, I'm happy to also go into a little bit of the regulation that's happening there, and also GDPR is, I guess, one topic that's happening quite a lot, and it's quite important. Let me just start off with explaining a little bit what cloud computing is. I mean, everybody has a view of that, and there's one definition. It's based on the one that has been made by the NIST, the National Institutes of Standards and Technology in the United States. It is the definition that has already been taken into all the regulation that I have seen. So it's been taken by, for example, the German regulator, but also in the European sector, the EBA has built its own definition also on that. And basically, it has 5 essential characteristics: on-demand self-service. So you are administrating the service yourself. You use it over a network. So that's network access, resource pooling. You are using resources that are shared between different customers, obviously not shared at the same time, but once you're not using it, somebody else can use it. Rapid elasticity, you can scale up and down based on your needs, and you can do that quickly. And obviously, measured service, you only pay for what you're actually using. What cloud is not, but are topics that are very often linked to cloud, are topics just like service-oriented architectures, for example, or continuous integration, continuous deployment, DevOps, DevSecOps, agile change management, and all these kind of things are all topics that are really linked to cloud and are quite often used in the cloud context, but are not exclusively cloud. So you can also use these technologies, these processes in other contexts. Okay, move on to the next slide. There are different service models which also make it using the cloud a little bit different, because you have different responsibilities with that. So looking at it, we have infrastructure as a service, platform as a service, and software as a service. So in a software as a service scenario, you as a client are actually using the application of a provider, and basically there is a web front end to that application, and there's nothing else to do there. Yeah? So you are dealing with actually putting your users into them, but you have no configuration of the application, of the operating system, of the databases. That's all hidden from your view. You're only dealing with the application front end. In a platform as a service, then that's basically the middleware is abstracted away from you, but you still have access to the application, so you can do configuration of the application, configuration of the client application, but everything else is then not viewed by you. So, for example, that would be database servers that are provided as a service to you. And then infrastructure as a service, that's closest to the traditional model of hosting, where you actually have everything under your own control, apart from the physical servers, and they are abstracted away through a hypervisor. But things like virtual machines and operating systems, applications, and all that are still in the in your own responsibility that you have to deal with yourself. And I've shown several cloud service providers on the right hand side here that are important in these sectors. And when we move on to the next slide, we can see a little bit better how exactly market shares are in this area. And these numbers are not absolutely current. Most of them are from 2018, 2019. Unfortunately, these numbers are not published very often. The Gartner reports and so on don't show the newest numbers, which is always a little bit of a pain. But what you can clearly see is there are not too many big players in this area. So there is certainly, and I think Dimitrios, you were also alluding to that a little bit when you were introducing me. We see a lot of American players in this area. So when we look at this, SAP is one that is European, but apart from that, almost all companies are US companies, and the only one that's apart from that is Alibaba. It's a Chinese company, and due to regulation, probably not a viable service provider for most banking clients in the European Union. But Amazon is with Amazon Web Services is in the infrastructure as a service area, is one of the most dominant players, and then going up the chain and the platform and software as a service area, we can see that Microsoft is also quite important, especially when we're looking at services like Office 365 and so on. They are quite popular and also quite used quite often. And going to the next slide, one of the big reasons why that is, why we only have quite a few big players that are relevant in this area, is really the amount of services those players can provide to their customers. And Google, Azure, Microsoft Azure, and Amazon Web Services really set themselves apart from the other providers in that space. So they have a really They have hundreds of different services that they offer, and they have a really complete portfolio of cloud services, and they are spending billions of dollars on that. And this is something the others cannot match. They have their niche offerings, but the breadth of services that those big threes, these hyperscalers, can offer is virtually unmatched. Alibaba is trying to close up, but also they still have a long way to go. And maybe looking at the European angle, is there any provider that is coming close? And honestly, I can't see anyone doing that. And I mean, there is a lot of interest from the political side and of having European champions in this area, but quite unfortunately, that is very difficult, and it's not really happening. Also, looking at those big three providers, when you're talking with them, when you are in trying to discuss with them, especially compliance and things like that, what you can see is that basically a lot of them have a very good understanding of what the compliance space is looking like. They're really eager to help you getting on with the compliance questions that you have. A big problem that comes up in this area is though that the knowledge and the availability of personnel is quite different. So, for example, if you're looking at AWS, they have they are really efficient in what they're doing, but also they have they get by with the least amount of staff in sales compared to the other big ones, and they are doing a lot just to cover that, and so you need to be aware that a lot of them, so a lot of the Microsoft and the Google personnel is much quicker to answer your questions. Next slide, having a quick look at what the banks are doing, and maybe not getting into all the details, but looking at what is happening. What I can see is that currently banks are moving into the cloud space if they have some kind of pressure. Yeah? So a lot of banks that don't feel the pressure, and be it a financial pressure from because they are part of a bigger industrial group, that the cloud adoption is one of the big group strategies, or pressure to innovate. If any of these pressures do not bear on a bank, usually what happens is that only small proofs of concepts are being done. If there is a lot of pressure, then there's also a move into the cloud that's happening, and that's what we are seeing quite clearly now. And at least in Germany, I can say that the first banking workloads are in the cloud already. With insurance companies, we see a lot more cloud usage, and then because especially with the all the calculations that need to be done, it's actually very easy to do that. If we move on to the next slide, we can see a little bit how the regulatory landscape is looking like. And we have the European regulators, EBA for the banks, IOPA for the insurance companies, ESMA for the more in the trading area. And just as an example, I've also included BaFin as the German regulator. And what we can see basically that there is really an alignment of what's being done. And for example, IOPA has explicitly said that they want to be in line with what the EBA guidelines say, so that you can be sure that there is a really consistent outlook on what the ask is from the regulator, and that's a really nice thing to see, that the European regulators are in line. And because they are in line, there's also the hope, and what we're currently seeing is that this is that is also happening, that the national competent authorities actually also are in line with that. And a big two things basically that you can see is that there are a lot of contractual requirements that need to be followed. And there's also a big emphasis on the risk analysis, so looking at the risks that cloud usage has. And there are specific topics that need to be covered in this area, but just let me show you on the next slide which risks actually there are. So there are lots of different risks. So this, for example, is one cloud computing risk intelligence map that we have, that you can also find, or you can ask us for, where you can see on a big scale what different risks are actually there. And they are regulatory risks, there are risks that are more information security, but there are also business risks. So for example, if you think about having using expensive cloud services, and once you're done with them, you should actually turn them off. But if you forget about that, then your costs will run on, and that can be quite substantive and problematic if you do that. Moving on to the next slide, what are the regulators most concerned with? It's just going around in a circle here. Concentration risk and sub-outsourcing. What we can basically see is, for example, that Microsoft is a very and also AWS are very popular cloud service providers. What happens if everybody is using that? Can that be a risk for the whole banking sector, for the whole financial services industry sector? And the regulators are very concerned with that. But unfortunately, that is not something that they have found a real way of dealing with. Then the sensitivity of data and systems, basically having enough security, privacy monitoring, and so on in place is really important. GDPR is also a big factor, and all the regulators also say that privacy should be taken into account when looking at the risks. So it's not only the information security risks, it's also the data privacy risks, and especially with the Schrems II court case, there's also a lot of pressure on the American providers, and the banks has a lot of uncertainty currently how to deal with that. But we will have to see. I think the future, the next few months, will bring a little bit more clarity with that. Location, applicable law, and political stability are important factors. Obviously, data should be processed in the European Union. That's the expectation of the regulator, and that's usually also not a big problem for the cloud service providers. Internal controls systems, obviously information security, privacy, as I've already said, and at the core of that, what you can get from the cloud service providers are so-called third-party assurance report or service organization reports, where you get assurance whether the ICS, the internal control system of the cloud service provider, is working well. And there's currently more or less there's a standard of which kind of service reports are being provided. The SOC 2 and the ISO 27001 certification are pretty much standard with all cloud providers. And then obviously cloud governance, with the expectation of the regulators that you should have cloud governance in place before you go into a cloud outsourcing relationship. And last but not least, audit rights. You need to have audit rights with the cloud service provider, and also there needs to be the audit rights for the regulator. So the regulator is also able to audit the cloud service providers. And this was one of the topics that a few years ago was really tricky, but right now almost all cloud service providers have come around from that and basically offer those audit rights to any regulated industry in the financial services sector. Going to the next slide, how do you deal with all those risks? Obviously, you need to have controls in place. Basically, the controls inside the cloud service provider I've already talked about. You get the service reports there. You have them covered by that. But you really need to think where your responsibilities are, which kinds of cloud usage are actually within your own sphere of responsibility, which you can influence directly. And that's really based on the service model that you've chosen with an infrastructure as a service model. Then you would have a lot of responsibility, and you would deal with that directly and have all these controls in place. But also the experience has shown that you should have some kind of control layer between the cloud service provider and yourself, where you can actually go in and make sure that certain services are actually not available to your users. So for example, if they do not fulfill the criteria, compliance criteria that you've set. So for example, data processing in states like China or so, you could actually say right in the beginning when you're configuring your services, no, I would not allow those, and then they would not be available to your users, and that would be a nice way of doing it. Also, doing it with code, so basically having the controls automated is a big thing in cloud computing, because there is a lot of controls that need to be implemented, and if you would want to do them manually, that would take a very, very long time, and a lot of these controls are very specific to the services that are being used, but there are blueprints out there that you can follow, and you can automate those controls, and I guess you can get an automation rate of 80 to 90% in this area, which would really help you with efficiency and having those controls in place. On the other hand, if you decide not to do that, you will most definitely have compliance problems, because manually it's almost impossible to do some of these controls, because they can get very complex and very detail oriented. And because of the fast changing nature of cloud services, also you would have to do them very frequently. And the last slide shows a little bit when you are introducing that, basically how you can do that. And this is based on the regulatory expectations. You should have a cloud strategy in place. You should then build your cloud governance, define your cloud controls, implement those cloud controls into code so that they are running automatically, and then now you are in a position to actually be in the cloud, and then you obviously have monitoring requirements that need to be fulfilled at the end. So that's the standard process that the regulator would like to see you. But honestly, I also have to say, most start with just going into the cloud and then building the governance and the controls later. Yeah, that's what's happening.
Sven, such an interesting topic, and I think the most current question, but both from the audience and myself, is there is a lot of regulatory pressure on the cloud. Yes, it is the future, but there are a lot of regulatory restrictions. So twofold question, yes. So is it even possible to go to the cloud? Does regulation make it possible? And how should one structure it? So I will give you a scenario, yes, and we have a medium-sized bank, and we have a cloud champion, yes, and her mission inside the bank is initially to get regulatory approval, yes. So what are the top 3 priorities that she needs to focus on, yes, in terms of securing regulatory approval? And if we have real life examples.
Mm-hmm. Absolutely. I think the most important step is actually understanding what's happening. Yeah? What is actually being done in the cloud. Yeah? That's the most important thing, and that's sometimes not easy, yeah? Because sometimes you're already using cloud without knowing it. So, for example, if you're using Dropbox, then you're already using the cloud. Yeah? And you need expertise to do that. So you need to have an organization that actually understands what cloud is. So if you have a cloud champion, then you need to make sure that this cloud champion actually has the necessary expertise to deal with that. And then once you get into the interaction with a cloud service provider, then obviously what you need to think about is from a regulatory point of view, is the risks. Yeah, so you need to do the risk analysis, and that's quite comprehensive. There are a lot of topics that need to be covered. It's information security, it's data privacy, it's architecture, it's questions about the cloud service provider itself, and so on. Yeah, so that's a big topic that needs to be worked on. The second topic I would see is the contract that you have with the cloud service provider, and looking at the contract and making sure that the right things are in the contract, and also dealing with things where you have an expectation by the regulator, but you're not able to 100% get that into the contract, which is the case actually with all the big providers. You always have topics which you don't get into the contract in the way that the regulator wants to see them. You need to deal with mitigations. Yeah, how do you mitigate those problems? And that's a big thing. And the third one is getting the cloud governance and the controls in place inside the bank, but also looking at what the cloud service provider should have in their own controls in place. That's also a big topic, I would see. I think we also got questions in the regarding the assurance reports, the third-party assurance reports. Should you as a bank use those reports? Absolutely, yeah. They make your life a lot easier. They are really well structured and really well prepared. But when you're using them, unfortunately, you still need to do your own audits. So you need to audit the cloud service providers. You don't need to do that every year or every 3 years, but from time to time, you need to actually make sure that whatever the report says is actually in place. But there is one possibility where you can actually collaborate with other banks in auditing those cloud service providers. That is one possibility that's actually officially been granted by the regulators, and there are collaborative audit groups. So, for example, there's one that has been started by Deutsche Börse and is now Europe-wide, and where the big cloud providers are audited every single year, and you can be part of that and then reduce your commitment to auditing those through these means. Edge computing certainly is one of the facets of cloud computing, and absolutely the same regulation would apply there. So basically, you need to look at the specific risks, at the specific use cases, and then make sure that you cover them as well. So there wouldn't be a big difference. And with the regulatory side, it's more, I guess, a technological and an architecture problem that needs to be tackled.
Thank you. Last question from me. Cloud changes the entire infrastructure, yes? So is something that you see as a standalone, or is something that changes altogether, like the operational risk framework of the bank? So should you see it as a venture with a risk mitigation plan, or should you go and rethink the entire framework that you have around operational risk?
Absolutely, it's a really good question, and I think one really important point is often the assumption is using cloud is more risky than using traditional hosting providers, yeah, or doing it in-house. But to be honest, that's not really the case. Quite often the amount of investments into security, into availability, into resilience of those systems from Amazon or from Google or from Microsoft are much higher than any bank could actually invest into those areas. And especially as a small or medium-sized bank, you can really take advantage of that investment by going into the cloud. But of course, once you're doing that, you are moving into a risk landscape that's a little bit different than the previous one. So you need to adapt what kind of threats you have, and you need to adapt what kind of exposure you have to certain risks. Some might be higher, some might be lower, but the risk picture will change, and you need to take that into account. But I would not say that the risks are actually larger once you move into the cloud. They might be just different.
Thank you, Sven. I really appreciate you finding the time to speak to us about cloud. And
Thank you.
we still receive a lot of questions, and it would be great if we had more time to respond to all of the questions, but we will make sure that the questions reach the speakers, the panelists of the day, so we can respond to everybody in private. And that brings us to the end of the last session of the week. You will all receive a survey. Survey helps us become better. We will repeat the risk and regulatory week in approximately 6 months. This is our target, and this is a concept that we would like to maintain, on a pan-European basis. So thank you again, and stay tuned for the next one. Thank you, everybody. Have a nice rest of the day.